It's time for Smart Charts with Abigail Doolittle, our weekly segment where we look at 3 charts on timely topics with the street's top technicians. Abigail.
Thanks, Scarlett. And today my guest is Ari Wald, head of technical analysis at Oppenheimer, an area, of course. Thank you for taking the time. And one of the big themes right now, technology, and more specific today, actually consumer discretionary name, Tesla. And you have a chart here of Tesla. So what does it tell you?
Doesn't tell me much. So the funny thing with Tesla, I get asked about this stock all the time, and I really don't have a very strong view because the stock is trendless. It's really been trading in this very wide range between about $365 on the upside, $275 on the downside. It's up post close today on earnings. I'm showing the 200-day, but just so that it's flat, it's going to oscillate above and below. I just don't see the setup either on the long side or the short side. We're on the sidelines.
So I have one question for you, though. What about the fact that if we connect the lower low back in 2016, which had to have been below 200, and then, a higher low and a series of higher lows, could you ever see the case that this is a larger ascending triangle that could produce a breakout to the upside?
You do have higher lows on this time frame. I think if you were to pull it back even longer, there's an uptrend that's been broken. You could then also make the case you've been making lower highs. So again, mixed evidence.
So you're on the sidelines of Tesla, stock that investors love to love and analysts sometimes not quite so much, but you're on the sidelines.
Sidelines. But here's one that we get another very popular stock that we do have a view on it, and that's Apple. Up big today on earnings. I think you stick with it. Here's why. And it's based on the stock's relative ratio. Now, this is how the stock's performing versus the market. This is what institutional money managers are getting paid on. This is what they care about. Are you beating the market? Are you not? And Apple is at a very important level. That the strength today is a breakout above resistance dating back to 2012. This is a 6-year breakout in the stock's relative trend. I think it indicates that the longer-term trend of outperformance is resuming. You want to stick with today's strength in Apple. Add to it on today's pop. Looks good.
That's a bullish call, then, certainly adding on the momentum. And then healthcare. Another breakout?
Rotation idea here. While Apple has had this nice run, we're seeing a rotation in healthcare underway. Now, the sector spider, XLV, coming out of this 5-month bottoming pattern. More encouraging, again, the action relative to the market. Here's a sector that had been an underperformer for much of 2015 to 2017, spent the last year building a base, successfully held its multi-year support level versus the market, and now beginning to turn higher, making higher highs, rotation potential. Broadly strong, too, across capitalizations, big cap, small cap. It's healthcare value, it's healthcare growth across industries. We think you want to stick with this strength in healthcare.
So Apple and healthcare. Thank you for those investment ideas. Ari Wald of Oppenheimer.